Hi, so in the last video, what I did is I incorrectly stated that the lines on the heat map are actually support and resistance. So those are actually magnet lines, and I will explain that a little bit later. The support and resistance lines is something that you can see from the order book, and I will show you where to find that as well. So in this video, I will try to correct my mistake. I will explain, how to look at the heat map and their magnet lines. Then we'll take a look at the order book and look at where to find the support and resistance lines. And then I will try to explain the volatility, why the markets are so volatile when the price suddenly moves in one direction or the other. And so what drives that sudden, let's say, sell-off or sudden spike. All right, so first, let me go back to that graph that we looked at in the previous video. So again, here what we're looking at is the coinglass.com. Specifically, this is the liquidation map for BTC. And as we can see, where the majority of the volume is for the liquidation, so those are going to be the magnet lines. And the reason for that is, let me switch to a different graph so it's a little bit easier to understand here. So as the price moves towards one of those lines, the individuals who have positions here, they will have to liquidate that position before it gets liquidated by the exchange itself. So if, like in this case, this is a short position, right? In order to liquidate a short position, they will need to buy to cover it, right? So they will need to buy the underlying asset in the most cases. So that further drives the prices up. And then similar going down, right? So if you have a long position and it goes down to that particular level, in order for you to cover that, then you have to sell whatever the underlying asset is. So that drives the price further down. So that's why those are mostly act like the magnet lines as opposed to support and resistance. But there is a way to look at support and resistance lines as well. So you have to look at the order book. So the order book, in this case, a real-time order book, obviously those positions may change, and they may change rapidly because of something else happens in the market, some news or whatever. So suddenly you have a large volume of open interest that comes in into the market that drives that. But for the most part, you can see that here, for example, at 78,000, you're going to have a major support line because there is a ton of buy orders. In this case, the total of almost 11,500 or a little more, actually, 11,500 Bitcoin volume, which is quite a bit of, Bitcoin in terms of dollar value. And then going up. So this is where the current trading occurs, where those two sort of open interest meet together. And then the other sort of resistant lines, as you can see, those are sell orders, right? At 92,000, at 96,000. And those are going to be mentally a lot of the traders, a lot of the individuals, unless it's algorithmic trading, they will set those around some of the round numbers, right? And what you can do as a trader or an investor, like if you want to, let's say, place a potential sort of sell order or buy order, you look at where those major accumulations are. Most likely, the underlying asset is going to be bouncing off of those lines. You will set your targets a little bit before those lines so that you have a better chance of executing whatever your order is, buy or sell. So anyway, like in this case, as you can see, 92, 96, there is a little less at about 105, and then another one is at 114. So those are sell orders, and then buy orders again here. Again, there's quite a few buy orders going all the way down to about 70,000, and then there's far and few in between, which basically means that the chances, the market doesn't anticipate that the underlying asset, in this case Bitcoin, is going to go down that deep, and so they're not bothering of setting those buy orders that low. Obviously, some individuals are, but they're hoping probably for a big liquidation or something. So now, basically, the market dynamics is driven a lot by that open interest and then liquidations, right? And when there is imbalances between the two, obviously there's a lot of other factors, but these are some of those factors that influence. And when there is a massive imbalance between the two, that drives a lot of volatility, right? So what happens is, as the price moves one direction, it will have to, so the liquidation orders come in, so the underlying asset gets sold or get bought depending on which direction it's moving. So let's say it's moving down, right? So all of those long positions get liquidated, so the underlying assets get sold, and so usually it is sold at very quickly at whatever the current market is. So that adds a lot more into the marketplace, a lot more volume, and obviously any resistance that was there, let's say any buy orders, they get swallowed up by all that influx or inflow of those, let's say, sell orders because of the liquidation. And so if you have more liquidation orders come in, then there is an open interest for buy orders. For example, if it's going down, it will just get swallowed. All of those buy orders can continue to go down. So when you have that massive imbalance, it continues to drive prices further and further down. And then once it drops below that resistance, it hits new liquidation targets, and then there is another influx, and you have that cascading effect of the price just starts to plummet until that entire sort of liquidation book or liquidation positions have eliminated, essentially, right? Or leverage positions are eliminated through liquidations, I should say it in that way. Anyway, or it hits a massive, let's say on the way down, massive resistance level where there is a ton of buy orders from, let's say, previous investors who've placed those in hopes that the asset will eventually hit there. And then basically that's where there is sort of they reach equilibrium, and then the underlying asset bounces back. Anyway, so I just want to make that correction, make sure it's clear. And going back to the last video about the crypto crash and what was driving it, basically the BYBIT had a hack. They lost 1.5 billion dollars of Ethereum. Other exchanges or other investors loaned a lot of money to them to cover those costs. Now they have to repay that. And what they're doing is they're clearing some of those positions, leveraged positions that some of the investors have on their exchanges in order to scoop up all that essentially tether. That's what they use to as a collateral. And also what ends up happening is they're selling more and more of that underlying asset, like in that case was Ethereum or Bitcoin, and that further was driving the prices down and giving them a chance to further scoop up or liquidate some of those open interest or rather leveraged positions. Anyway, and that's how they made a lot of money. And so the premise right now is that, hey, there is nothing really left there to make more money. I mean, a little bit, but not a whole lot like it used to be. So that the stronger the line here is, and the brighter the line, like yellow and like green, whatever, those are massive positions here. So they got liquidated, and then there's a lot more now on the way up, right? So all of those short positions. So, well, now everybody expecting there's going to be a short squeeze once the market bounces back, and all those exchanges are going to benefit one more time from squeezing all those shorts and getting all of those leverage positions eliminated. Anyway, so this is what I wanted to quickly share with all of you, make sure it makes sense. And if you disagree, again, leave your comments below. I would appreciate to hear more from you. Also, always curious to hear what sort of crypto you like and why you like it. And if you have any suggestions for what we should cover in this channel, please let me know.